Let's face it, losing money is never fun. But when you're a long-term investor in the stock market, there really is no reason to panic. You see, you might be worried about your portfolio with the recent stock market dip since the start of the new year, but no matter how in the red your portfolio is, short-term losses don't have to interrupt your long-term goals. Because when you're investing for the long term, you might actually begin to see the opportunity that these market dips can actually present. Firstly, we need to actually plan for short-term losses. Whenever volatility hits the stock market, our first instinct may be that something's wrong with our investments, right? Something's wrong with our portfolio. But the reality is, guys, that there's actually nothing wrong going on. You see, the stock market, its natural cycles includes short-term losses. And if you look at the history of the US stock market over the past 100 years, it's always had its times of dips in the markets. After all, if the stock markets just continually rose and never declined, we wouldn't have the inherent risk the market brings, which makes it possible for us to actually get rewards. The reality is we all have the ability to grow wealth through the stock market, but it does take time. Despite these declines, in the grand scheme of things, each major dip has recovered and minor dips are often short-lived. And as with anything in life, guys, when it comes down to it, you always have to ask yourself about risk versus reward, because the higher the risk, the higher the potential for reward, right? And as everyday investors, we invest in stocks because of this very reason. Now, while investing in the stock market does carry more risk than placing your money in, say, a bank savings account or a CD, the stock market also gives you the ability for much higher returns than your standard bank account or CD ever could. So if you're ever looking to grow your money over the long term, it's not about eliminating your risk, it's more about managing and minimizing that risk for your investment goals and for your personal risk tolerance. We need to look at the bigger picture. When you wake up every morning and you see your portfolio in the red, it's important to develop some perspective. You need to think long term, not as in days and weeks, but as in years and even decades. Using this perspective, guys, you begin to see the stock market that it represents one of the best ways to build long-term wealth available to us everyday investors. For instance, take a look at the historical performance of the stock market. According to data from macrotrends.net, which is a research platform for long-term investors, over the past 100 years, the stock market has averaged an annual return of around 8 to 10%. And yes, guys, that's even factoring all the major stock market corrections and crashes of the past century. Now, do keep in mind that stocks are long-term investments, and that if you do stay the course over time, your investments will pay off in the long run. So let's talk about shopping for bargains, because when the market dips, instead of getting stressed that you see your portfolio in the red day after day, you should actually think about it as an opportunity to buy stocks or ETFs at a discounted price. You see, dropping markets can actually be a good time to buy stocks and quality companies at a bargain price. These are stocks that you could consider have gone on sale. Think about it. A stock that looked like a strong buy at $100 a share will be an even better buying opportunity at $80 a share, right? And buying stocks at bargain prices is actually one of the best ways to double your returns when the market eventually recovers, and guys, it always does. When buying new stocks on sale or simply adding to your existing stock holdings, you can more than make up for any short-term losses in the long term. In fact, you might actually even begin to look forward to these short-term losses as a great buying opportunity. It's also important to take your time and never pressure yourself to rush into any decisions. When our portfolios experience several days or even weeks of declines, it can be tempting to sell off all your investments before they keep declining further, right? But the truth is, no one actually knows when we'll reach the bottom of any stock market dip. And regardless of the current market volatility, if you're a believer in the companies or the funds which you invest in, there's really no need to rush into selling your stocks or your funds, right? There's no need to sell a company with solid fundamentals and a bright future that you actually believe in just to avoid some short-term volatility. For instance, if you bought a company at $100 a share and the price then drops to $80 a share, it's still a good hold as long as the decline isn't a reflection of a major change in the company itself. And with the broad market decline, guys, it usually never is. Plus, remember that even in a market decline, you haven't actually lost money until you sell. That's why investing long-term takes self-control. Never put yourself into a position where you feel the need to panic sell, because in reality, there's a very high likelihood that you will end up selling your stocks at the worst time possible, only to watch them soar in value soon after. Again, that's because when it comes to stock market declines, you never know when we'll actually hit the bottom, and you never know when the recovery will begin. But if you pull out and panic sell your investments, you might just miss the recovery altogether. And one of the worst things that you can do, guys, is sell a stock, for example, at $80 when you bought it for $100 just to end up buying back in again at $120 6 months later down the road after realizing that you sold it at the wrong time. You panic sold, and this does nothing but locks in losses on your investments. Alright, so what are some actionable steps you can actually take to manage your investment risk? Well, two of the most effective ways to manage your risk are through diversification and through dollar cost averaging. You see, having too much equity in your portfolio invested into a single stock, well, that could be contributing to some of your stress, right? And one of the best ways to diversify your investments is through investing in ETFs, also known as exchange traded funds. And if you're unsure how to get started with ETFs, today's video sponsor Wealthfront makes it extremely easy for anyone to get started investing with a diversified portfolio of low-cost ETFs, automated investing tools, and one of my favorites, the ability to track all your investment accounts in one single easy-to-use app. As one of the leading robo-advisors in the investing space, Wealthfront software automatically handles all the trading for you and rebalances your portfolio on a regular basis as well. And thanks to their built-in tax loss harvesting feature, Wealthfront can even help lower the taxes that you owe come tax season. Now, another great strategy to help minimize your investment risk during market declines is to dollar cost average your investments. You see, with dollar cost averaging, you set up an investment schedule to invest the same amount of money on a consistent basis. Whether that's every week or it's every month, you're investing the same amount of money into your investment portfolio on that consistent basis. Again, regardless of if the market is up or if the market is down, by following this strategy, guys, you avoid the need to try to time the market. You avoid investing all your money when stocks are at a high, but you also get to take advantage of buying stocks when they're at a low. So essentially, you get the best of both worlds. Now, Wealthfront makes dollar cost averaging very simple as well, allowing you to schedule deposits from your bank into your Wealthfront investment portfolio directly. Now, whether you start with their expert-built classic portfolio or a socially responsible portfolio, or you simply want to build it yourself, Wealthfront allows you to explore hundreds of ETFs that have been vetted by their own research team, including funds focused around things like clean energy, healthcare, tech, crypto, and even more. Now, if you would like to open up your own Wealthfront portfolio, you could actually get your first $5,000 managed for free when you sign up and join through my special link down below in the video description box. Now, if you're new to robo-advisors, I definitely recommend checking out this video right here where I break down how the Wealthfront app automates your investing and allows you to track all your investments from a single dashboard. Because whether you're investing in stocks or you're investing in crypto, this is definitely something worth checking out. So click on over in that video and I'll see you right there.